my computer. Anyway, so I think it's really interesting, and he kind of had to go through it fast last time, and according to my attendance, almost nobody was here, and the people who were here were he kind of went through it very fast, and I'm not sure people were really prepared for it. But I think it's probably the best introduction I've ever seen to foreign currency accounting, ever seen any place. And I think it's really interesting and it's important. So we went over that together last week, and we kind of shifted it. He changed it around a little bit, but I think it's a really useful introduction to foreign currency accounting, which you're going to have in Chapter 12. What I'm going to do here is, this has always driven me crazy, is I don't like the way the chapter presents the cases in fair value and especially cash flow hedges. And my experience is, I use the same videos for several years in a row, and the chapter hasn't changed from previous editions, so I've actually been using similar materials for several years. And whenever I see the quizzes, I always get frustrated because I feel like students aren't really understanding the difference between a cash flow hedge and a fair value hedge, and the chapter doesn't really cover it very well. And so since my videos stick to the chapters, I'm not covering it very well either. The problem is that when I develop my own materials here, because I was never satisfied with them either. So actually I was working with Wei Long on Monday and thinking about the whole thing, and I decided to make some compromises on how I design the stuff. And I know it's probably hard to believe, but I'm a perfectionist. At least I try. And like when I'm teaching things, I like for everything to be right, and I don't like to cut any corners. That's the reason why I never set it up this way. But I thought about this pretty hard over the last couple of days, and I came up with a way to explain hedge accounting. Now I took some shortcuts when I did this. I'll explain what the shortcuts are as I go through it. So you're going to have to forgive me, but I think that this approach is going to illustrate for you the three methods of accounting and the primary differences between them so you can better understand the journal entries. I streamlined some important details out of this, but if you understand this, then you'll understand 90% of hedge accounting simply by understanding these 3 pages. So but you won't understand 5%, and to be honest with you, some of this is wrong. I'll just say it flat out. You can put in, professor teaches us wrong stuff. What I'm doing is I'm taking a shortcut to make it very clear, and I'll explain to you what I'm doing here that doesn't quite fit in with the FASB or with financial principles. I'll just tell you what I'm doing as I go through it, so you know what piece of it is kind of suspect. But it might not be wrong. I don't like to teach things that aren't 100% right. But this time, I think, for the sake of clarity, it's worth it, because what the book does, what other textbooks do, just isn't clear enough, because they're trying to check all the boxes and get everything perfect. So I kind of took a shortcut here, and we'll go through it. But I think this is a good lesson in how hedge accounting works. Now, one other announcement I just want to make before I start. We have a quiz due next Tuesday. What I'm going to do is I'm going to shift the due date to Wednesday. And again, I'll have office hours on Wednesday afternoon and evening, so you can come to my office and take a pencil and paper quiz. Now, the good news is I'm giving you an extra day. The bad news is, I'm sorry, I thought hard about how to do this. And in the past, what I always did was I hit one subject in Chapter 11, and oftentimes I hit one subject in Chapter 12. So that meant I covered about a quarter of Chapter 11 in the quiz, and maybe a third or half of Chapter 12 in the quiz. So if you study the wrong part of the chapter, you might as well just give up. And I never liked that system, and I was really afraid that it would be especially confusing for you guys, because I have an online quiz, and then people come in and do pencil and paper. So I'll tell you what I was afraid of. I was afraid that if I did one type of accounting on the online quiz, like let's say I did cash flow accounting, then everybody would think he did cash flow accounting for the online quiz. He's not going to do cash flow accounting for the pencil and paper quiz so we don't have to study it. And then I ask that and everybody gets it wrong. Or if I don't ask it and whatever, so that people would, word of mouth would really mess people up here. Or that people would think that because I did cash flow accounting, they have to, that's what I'm going to do on the pencil and paper too. Or I'm going to do different ones. And you know what, I decide I'm going to take a completely different approach with this quiz. And you might not like this, but this is what I'm going to do because I think this is fair, is it's going to be multiple choice. So it'll be 10 questions on chapter 11 and 12. I'll tell you exactly what the questions are going to be about, because this is the only way I can cover the material without giving you a 3-hour exam. And I don't want you to have a 3-hour exam. I just want to see what people remember from the chapters. Sorry, Mary's like, looks like she's ready. You don't know if she should laugh or she should cry. I didn't have any, I just think this is the fairest way to do it. And I detest multiple choice, but this is the only way to do it. I'll tell you what you need to know though. You need to know the 3 methods of hedge. You need to know foreign currency transactions, the beginning of chapter 11. You need to know 3 types of hedge transactions: an exposed position, cash flow hedge, and fair value hedge.
Could you slow down, please?
Oh, you know what I'll do is I'll write it down for you, okay? And you have it all on recording. This is basically what's in the chapter. Unfortunately, I'm not like excluding very much. But this, all of this, if you look at the CPA exam specs, you'll see that the CPA exam is really into everything that we're covering right now. So I can't take shortcuts with this. So one thing is foreign currency transactions. This is chapter 11. An exposed position, a hedge of an exposed position, or an exposed position basically, which would mean that a hedge that's not a documented and tested hedge, a cash flow hedge, and a fair value hedge. Chapter 12, you need to know what's that functional currency? What does functional currency mean? What currency would you choose as your functional currency? You need to know when to apply and how to apply translation and remeasurement. So that looks like it might not be a lot. See, and the problem is, again, I would always pick one from the top and one from the bottom. And if somebody studied the wrong thing or they didn't get to that piece of it, like if you look at the old quizzes, I once asked about the exposed position, a speculative hedge. I asked about a speculative hedge, and everybody got it wrong because that wasn't the one they studied. So I don't want that to happen. I want the quizzes to portray what you have studied. So instead of choosing one from each, I'm going to cover, if I don't cover all 7, I'll probably cover 6 in the quiz. And this way you can show me what you know or what you don't know, and this way I could get a sense for where everybody is. So that's going to be how it's going to be. I'm hoping to have it posted by tomorrow or Friday morning. If I can't, then I'll have it up by Sunday night, and then it'll be available till Wednesday night. So I'll send you an email once the RP Now quiz is posted, and then I'll also send you an email with a time that we're going to have the written pencil and paper quiz on Wednesday afternoon. So if you want to come in for that. If you can't come in Wednesday afternoon and you can't take the RP Now quiz, and by the way, if you run into a technical problem with the RP Now quiz, please, and even if you call them up and you can't get it to work and an hour is up, don't just like go home and forget about it. All right, send me an email. Send me an email, text me if you want. You got my cell phone number. I want you to be able to finish the quiz. So I'll work with you and we'll figure something out. I don't want anybody to be in a situation where they started the quiz, they did most of it, or there was a computer glitch or something, and their work was lost. And now that's it for the quiz. Thank you very much. Have a nice day. Yeah. 10 multiple choice questions for both chapters. I want it just to be short and sweet, see what people know, what they don't know, and that's it. And I'm gonna really try not to give you like 10 total, 30 minutes, something that should take you about 30 minutes. I'll give you 60 minutes, but it should take about 30 minutes, yeah.
So are the format of the questions going to be like in the line of the questions we do online for the online?
Probably, yeah.
Okay.
They may be different, but it's the same kinds of questions. They're CPA style questions. Sorry. I hate CPA questions. Yeah. No, I just, you know, to me, it doesn't always tell me if students really understand the material or not. All right, so let's go over this example. U.S. firm, and again, I designed this example. To be honest with you, I'm not creative, I'm an accountant. So I looked at several textbooks, and then I used them to design this. So this is my creation, but I took from here and there to put it together. No one does anything like this. So the U.S. firm contracts to sell equipment to a customer in Europe, and they're a manufacturer, and they're selling to this customer in Europe. And the sales price is denominated in euros. That's very important. It's 100,000 euros. The sales price is 100,000 euros. The expected cost to manufacture and deliver is $50,000. The date that they enter into this contract to sell is March 1st, 2017. And they're supposed to deliver the goods and get paid for it, 100,000 euros, on March 1st, 2018. So the company is concerned that the value of the euro is going to change. Let's say that the euro becomes worth less. That means they would get less US dollars, and therefore they would make less money. So they want to lock in the amount of money that they're going to make, and therefore they enter into a forward contract to sell 100,000 euros at a rate of 78 cents. So in other words, what would happen here, what their plan is, they're going to sell the goods, get 100,000 euros, trade in that 100,000 euros for 78,000 US dollars. And now they know how much money they're going to receive. It's an important point here. The company is concerned about how much money they're going to collect in US dollars. They're concerned that the value of the euro is going to go down, and therefore they're going to get less US dollars. But, and this is the important but, this is what makes it an exposed position. They're not documenting this as a hedge. I don't know why. Maybe they just don't know how to do it, or maybe it's not considered an effective hedge for a highly technical reason. There are a lot of things that need to be done in order to establish that something is a legitimate hedge, either cash flow or fair value, and they haven't done those things. Remember when I said it's 5% of this? That's a little bit iffy. That's it, because why would you do that? It doesn't make any sense. Of course you would do this as a hedge as a legitimate cash flow hedge transaction. But they're not doing it that way. And it could be, there's a perfectly good reason why they wouldn't, because they don't know how. Or because they didn't document it properly. The funny thing about hedge accounting, you know, and this is a very important point to get, is that if you don't do the paperwork properly, then it's not an effective hedge, and you have to use exposed position accounting. It's mind-blowing. Nothing else in the FASB never says that. You have to do documentation and testing to establish that it's an effective hedge. And if you don't do that testing and documentation, it becomes an exposed position automatically. And what's mind-blowing about this, my friends, is that you might not have done the documentation, and it really was a good hedge. But because you didn't do the paperwork right, it's not. It's a mind-blowing rule. FASB never says this about anything else in the universe, but that's what it is. So in this case, they didn't do the paperwork properly, and they're okay with this being an exposed position. So these are the various rates. They start off when they enter into this agreement, the spot rate for the euro is 80 cents. And again, the way you know this is a direct exchange rate is that it's denominated in dollars. So you would say 1 euro costs 80 cents. If this was denominated in euros, you would know it was an indirect rate, and you would say $1 equals so and so many euros. And Damien's going to talk about that in a few minutes. And the deal is that they're going to be able to sell those euros for 78 cents later on. In other words, they're going to collect the money for the equipment, 100,000 euros. They're going to sell those 100,000 euros and get $78,000 cash. And they know exactly how much money they're going to receive. That's why they're entering into this transaction. Now, December 31st, the spot rate goes down to 79 cents, and the forward rate goes down to 76 cents. And then by March 1st, the spot rate is 75 cents. Anyone know why there's no forward rate on March 1st? Because March 1st, if the forward date is March 1st, then there's no point. It's not forward anymore. That's the same day. It's all March 1st. So let's look at these transactions. And what I did here was I have columns for the journal entries themselves, and then I set up columns for the individual accounts so you could see what's going on in there and see how this cleans up. If you have an exposed position, and I sometimes confuse exposed position with a speculative hedge. The truth is, the difference is that an exposed position would be a situation where you kind of have both sides of the transaction. You have you're selling something for euros, so euros are coming in, and then you have a hedge transaction to hedge the value of the euro. With a speculative hedge, you only have the hedge, and there's no other side to it that's going to offset the change in value. So having a speculative position means that there's no other side to what you're doing. And those are kind of accounting terms, I think, more than finance. So here we enter into a contract to sell the goods for $78,000, really 100,000 euro, and we book dollars receivable from broker, debit 78,000, that's an asset, and credit foreign currency payable to broker. So the deal is like this. The broker on March 1st, 2018 is supposed to pay me $78,000 cash, and I have agreed to give the broker 100,000 euros. And that's worth $78,000. Now, the way this goes on my books, then, is I'm going to have an asset for 78,000, and I'm going to have a liability, foreign currency payable to broker, sorry, this is in the wrong row, of $78,000. And this is where my problem is this liability here. Because I'm concerned, and we'll get to this when we get to the fair value hedge, I'm concerned that the value of this liability is going to change. And because I don't really know how much, I may be concerned the value of the liability is going to change. Just leave it at that for now. So December 31st comes around, and the value of 100,000 euros has changed. I have to turn off notifications on my computer. The value of 100,000 euros has changed on March 1st, 2011 to 76 cents or $76,000. So when I have to give up 100,000 euro, that 100,000 euro I'm expecting to give up, which was once worth $78,000, according to the latest exchange rates on December 31st, are now worth only $76,000. So that would be a gain because the amount of the foreign currency payable, the expected value of the amount I'm going to have to pay, has gone down. So therefore, I'm going to debit foreign currency payable to broker. My liability goes down. And when a liability goes down, that's going to be a gain. So my liability has dropped to $76,000. And I have an exchange gain here of $2,000. And let me just give you a side comment on what's negative and positive. In these right columns, I'm using I don't know if you've seen this in practice or not, but in practice, it's common practice to make your debits positive and make your credits negative. So when you see negative $78,000 under a liability, that means it's a credit. It doesn't mean it's a negative liability. It really means it's a credit balance, and therefore that is obviously a liability. If I'm going to debit the liability for $2,000 like I did there, then the liability goes down to $76,000. Same thing for the gain. The gain is shown negative because it's a credit, and therefore a credit balance in a gain is of course a gain. So don't let that confuse you as a negative gain, therefore it's a loss. That's not what I mean at all. In these right columns, from here to here, the debits are positive and the credits are negative. I used to make everybody do all the spreadsheets like that until I started using Connect. Okay, so December 31st, we have to mark the variable values to market. I'm going to reduce, therefore, the value of this liability from $78,000 to $2,000. And now on my balance sheet, I've got dollars receivable from broker for $78,000 because that's been fixed by the forward exchange contract. And I have a liability for $76,000 because 100,000 euros given up on March 1st as of December 31st is now worth $76,000. And again, I want you to notice that the company may be concerned about this balance sheet value fluctuating. We're going to get to that when we talk about the fair value hedge. Next, before we go to March, before we close the transaction and we deliver the goods and we collect the money, we're going to mark everything to market again. So what's happened on March 1st, 2018 is that the spot rate went down to 75 cents. And that's good. That means that the euros that we're giving up are actually the value of the euros that we're going to be giving up are worth a little less. So the first thing I'm going to do is I'm going to write down this liability to market value again. It would be 100,000 times 75 cents or $75,000. And therefore, this liability needs to be marked down to $75,000. That's going to be a $1,000 exchange gain. So therefore, I'm going to debit foreign currency payable to broker for $1,000 in order to bring this down 5,000. And the other side of the transaction is an exchange gain. It goes right to the income statement for $100,000. So last year we had a $2,000 gain. This year I'm going to have a $1,000 gain. It's very interesting because you're not actually making any money. I mean, when you think about it, right? If you hadn't entered into this contract, you would have received $75,000 worth of euros, right? At the end of the day, you get 100,000 euros, and that's worth $75,000. Because they entered into this forward exchange contract, they're getting $78,000 for it. So that's where the $3,000 gain is, you see? Let me repeat that again because it's an important thing to understand. Because they entered into this contract, the contract says they're entitled to exchange 100,000 euro to $78,000. If they hadn't gone into the contract, how much would they be able to exchange those euros for on March 1st, 2018? 75,000. So because they entered into this transaction, they saved $3,000, and that's why there was a gain. 2,000 of it was recorded in the first year in 2017. 1,000 of it was recorded in 2018, right over here. Okay, so now we've written up the foreign currency payable to broker. We've written it down to $75,000. And my dollars receivable from broker is still $78,000 because that's what the broker has to give me for 100,000 euro. And let's close everything down. So the first thing I'm going to do here is I'm going to book my sale. And this is where things get a little sticky. I want you to notice it's not sticky at all. This is where something is going to be different from what we're going to do later on. My sale is worth $75,000 because the foreign currency hedge is a completely different transaction from the sale of the equipment. There's two things going on here. I'm selling equipment and I have a hedge. Selling equipment is selling equipment. Having a hedge is, it's not really hedging anything because it's an exposed position. So having a hedge is like an investment in a hedge. And I had a $3,000 gain from the hedge over here. So I sell my equipment and I debit investment in foreign currency. So I think our book uses a slightly different term. What does it use? Investment in FCU, foreign currency units. It's the same thing. These are euros. We have 75,000 worth of euros when we make the sale. Right? They give us 100,000 euros. That's worth 75,000. I'm not going to put 100,000 euros on my books because my books are kept in US dollars. So I put into my books the US currency equivalent of 100,000 euros. I also record my cost of goods sold, debit cost of goods sold, credit inventory. So you can see here there's 25,000 in gross profit. And now I have 100,000 euros on my books. I give the 100,000 euros to the foreign currency broker. So I credit investment in foreign currency for 75,000 and debit foreign currency payable to broker for $75,000. In exchange for that, I receive $78,000 in cash, and I credit dollars receivable from broker for $78,000. And now everything has been cleaned out. My balance sheet is totally clean. Asset of whatever this first item was, foreign currency receivable from broker. That asset, dollars receivable from broker is gone. The investment in foreign currency is gone because I exchanged my euros for dollars. I always like this last transaction. I just think it's cool. I don't know. You exchange this currency for that, this receivable for that, and then everything is all gone. I really like how it cleans up. Liability, I have the foreign currency payable for broker. I pay this off by giving them 100,000 euros, so that's gone. And what's left is a $1,000 gain that's going to go to my income statement. So basically, again, what you have here is you have two different things going on at the same time. If you take this perspective of an exposed position, you have on the one hand a hedge, which is simply an investment. It's a financial instrument. And on the other hand, you have a contract to sell goods for 100,000 euros. And we know how to sell goods for euros because that was at the beginning of chapter 11. And the hedge is like any other marketable security. It's just a marketable security. You know, you mark to market. I don't know if it might not be marketable security. I don't know. It might not be marketable, but it's a financial instrument that you mark to market. Now let's look at the same scenario, assuming that they document it as a fair value hedge. Yeah, Scott.
And when you're booking the sale transaction on March 1st, why is your debit entry not AR?
Because I'm getting paid. They give me 100,000 euros, and I'm booking the sale.
Right, but investment in foreign currency, why?
So you could look at it this way, okay?
That's an AR account, really.
No, look at it this way. Cash, euros. You could look at it that way if you want. It's euros.
I mean, not even AR.
I don't like the term investment in foreign currency because it makes you think of foreign currency as like an investment in another company. And I just did that for expediency. But you can think of this just as euros. We booked a sale and we got 100,000 euros.
Well, it's a cash receivable.
Yeah, it's not a receivable.
Yeah, I didn't mean receivable. I meant the cash.
Yeah, it's cash. I mean, legally it's cash. I mean, accounting-wise, it's cash. But I'm gonna leave it the way it was. But keep in mind, investment in foreign currency it's cash, is a cash and cash equivalent. All right, now let's think about this in another way. Same problem, and that's my brilliant idea. Same problem, but we're going to document this as a fair value hedge. And the reason why it's a fair value hedge, remember I said some of this is kind of iffy, I'll tell you what's iffy, is because I'm worried about the value of this foreign currency payable to broker changing and causing havoc on my income statement and balance sheet. I don't want this foreign currency payable going up and down because it's going to affect my equity, and the gains and losses are going to throw my income out of whack. And the fact is, the only reason why I'm entering into this transaction is I'm trying to reduce risk. So I'm entering into a hedge transaction, and the truth is that by entering into the hedge transaction, I'm eliminating risk. So why should I have to deal with risk on my balance sheet and income statement of liabilities flying all over the place and gains and losses hitting the income statement and making everything all crazy? I've entered into this hedge transaction in order to stabilize things and establish that I'm going to receive $78,000 when I deliver the goods. Does anybody see any risk in that? And that's why I'm going into this. So if you document this as a fair value hedge, in other words, it's an effective hedge, and you do the proper documentation. And what makes it a fair value hedge, I'm skipping over hundreds of pages of FASB here to explain this in a very simple way. And in reality, there's hundreds of pages of FASB that you could go through, and there's a lot more detail to what I'm saying than what I'm saying, but I'm streamlining this to keep it simple and understandable. What I'm saying here is I'm concerned that this liability is going to change and mess up my balance sheet, and the mark-to-market adjustments are going to screw up my income. And the reason why that's so important is that, let's say I'm a bank. The Federal Reserve, if my equity drops because of a change in the value of euro, I will be out of compliance with the Federal Reserve. And then I'm going to be in really big trouble. Or I may violate a debt covenant, which would force all of my debts technically to become due. So I want a stable value on my balance sheet. I want stable values on my income statement. I don't want, if the euro goes out of whack and goes crazy, I don't want it to really mess up my financial statements and cause something terrible to happen. And that's why I entered it to the hedge. So think about what's happening here. There's two separate transactions, and because we've established their effective hedge and we've documented it, then they become cemented into one. And now, in substance, what am I doing? I'm selling goods for $78,000. So you could say, hey, I'm selling goods for 100,000 euros, and I'm entering into a hedge transaction. That's what we did before when you had to suppose. When we establish an effective hedge, it becomes one. And now I'm selling goods for $78,000. And all the journal entries I'm going to show you are just flip-flopping all kinds of messed up little moving things around to make sure that my balance sheet stays stable and my income statement stays stable, because in substance, I'm selling the equipment for $78,000 1 year from now. So watch how this works.
That's effectively what you accomplished on the exposed position by locking.
No, I didn't. Because since I didn't, it's a good question. Thanks for bringing it up. Scott, because I didn't document it, it's two completely different transactions that have nothing to do with each other.
But your end game is you locked it in.
I didn't document it.
Right.
It's not considered an effective hedge, and therefore they're two completely different transactions. The reality is exactly like you said.
Right.
Reality is it's really one.
Right.
And it works, they both work exactly the same way.
Right.
But because I didn't document it, they're separate. So I got to book all the gains and losses on this right to the income statement. And watch the special treatment I'm going to get because I documented an effective hedge. Look at this beautiful treatment that the FASB allows me to do. First thing is exactly the same. I book my dollars receivable from broker, $78,000, because the broker is going to give me $78,000 for my 100,000 euros. I credit foreign currency payable to broker for $78,000 because that's what 100,000 euros is expected to be worth on March 1st, 2018. December 31st, the value, the forward currency value of the euro drops to 76 cents. So therefore, the amount of the liability for the foreign currency payable to broker goes down by $2,000, and I book a gain for $2,000. Now it gets scary because this is what I don't want to do. I don't want to have a lot of these gains and losses upsetting my income and messing up my balance sheet. Because what could happen here is that let's say it went in the other direction, the liability starts going up, my capital ratio goes down, and before you know it, the Federal Reserve is calling me and telling me that I need to liquidate some receivables, some deposits in order to increase my equity. I don't want that to happen. I have no control over the value of the dollar versus the euro, so how can I let that upset my balance sheet? So what the FASB says is you could do a reciprocal transaction. And this is completely phony baloney, my friends. And that's why it's so confusing. The FASB says you could do a reciprocal transaction to offset the gain and put it back on your balance sheet. So what you do is you debit exchange loss to offset this gain, and you credit firm commitment for $2,000. What the firm commitment says is that I'm going to have to give something up worth $2,000 later on. Who knows what? If you try to understand what this is, let me know, because I'd like to know myself exactly what the firm commitment means. I used to explain it, and then thinking about it more, I'm like, no, it doesn't. It's really like impossible to explain what they really mean by firm commitment here. But what they really are trying to do, and this is the important thing, is they're trying to keep your liabilities at $78,000. That's what's really happening here. So basically, they're just moving the $2,000 out of foreign currency payable to broker into firm commitment. And I can give you a technical reason why this is a legitimate liability. I'm not going to waste your time with that right now. In substance, what's happening is that total liabilities are still $78,000. This exchange loss offsets the exchange gain. I got to book them both on my income statement separately. I can't net them against each other. So it's going to kind of gross up your income statement a little bit, but total income is unchanged. The reason why I think FASB did this is because they didn't want people to be too fooled by what was going on. I think they wanted people to be aware that there was a possible source of volatility here. So watch what's going on here in terms of the accounts. In terms of the accounts, the foreign currency payable to broker has dropped to $76,000. But now I have this firm commitment for $2,000, so total liabilities is unchanged. Remember what I was worried about. I was worried that my liabilities would increase or perhaps decrease and be all volatile and mess up my balance sheet. But by booking this firm commitment, these together form $78,000 and liabilities remains the same. Furthermore, I don't have to worry about, remember the other problem? The other problem hit my balance sheet pretty bad. I mean, it hit the income statement pretty bad because I'm taking all these gains. You know why I don't want gains? Because I don't want losses either. I'm not in the job of speculating in euros. It's just not what my company is all about. I don't want any foreign currency gains or losses. I don't want to have to worry about the value of euros. I just want my $78,000 when I sell the goods. So therefore, the $2,000 gain, because this is a fair value hedge, it gets offset by this $2,000 loss on the income statement, and the net effect on net income of rebooking the gain and the loss is going to be zero. Now, how is this disclosed in the financial statement? You should always ask that question, by the way. Students don't ask the question, and we professors don't tell you, but disclosure is very important. The fact is that most companies will report this net on their income statement. They'll report it really as zero on the income statement. But in the notes to the financial statements, they're required to disclose them separately. So if you look at companies' financial instrument notes carefully, you'll see that they'll provide you the net gain or loss on the income statement, and they'll break that out into gross gains, gross losses, and offset them in the notes. So what's happened here is that I still have $78,000 in liabilities, and nothing has hit the income statement. Because what's going on in substance, if you have an effective hedge, I'm selling the goods for $78,000. Now, let's go down to March 1st. Getting a good workout here. So March 1st, the party's over. I'm ready to deliver the goods. Before I deliver the goods, and by the way, this is an important thing, I always mention this to students around now, is that before you sell something, if it's a mark-to-market transaction, you always want to mark-to-market the asset before you sell it. The same goes for, and this is a good CPA thing, the same goes for fixed assets. Let's say you sell fixed assets. The first thing you do before you sell a fixed asset is you depreciate it up until the date that you stopped using it. So what's today, March 28th? Let's say that I stop using this machine today and I'm going to sell it today. First thing I do before I go and sell it on my books is I depreciate it up to March 28th, 3 months worth of depreciation, and then I sell it. The difference is very important. You can't just, because what will happen otherwise in a typical company is you did your year-end close, you depreciated up to December 31st last year, you're like, oh, let's sell the asset. What's the book value of the asset? How much am I getting? What's the difference? That's a gain. That's not how you do it. You depreciate it up until the date you stop using it, so you record that additional depreciation, and then you'll actually have a higher gain. And that's, all right. So in this case, I market to market. I love saying that. Market to market. Let's market to market one more time. And the thing is that the value of the euro now has gone down to 75 cents. So my liability has increased. My liability has gone down to $75,000. So I'm going to debit foreign currency payable to broker and credit an exchange gain like I did before for $1,000. But again, so here you can see the liability is going down by 1,000 and I'm booking a gain for 1,000. Why is the gain shown as negative? Because it's a credit. And it gains or credits. But because this is a fair value hedge, I can sort of take it back. And what I'm going to do is I'm going to book this reciprocal transaction again. I'm going to debit exchange loss for $1,000 and credit firm commitment the liability for $1,000. This way my liabilities is still $78,000 and nothing hits the income statement. Everybody good? Because what's going on? Tell me what's going on in substance. I'm selling the goods for $78,000. So why would I record any gain? Why would any liabilities change? You see? The previous example, Scott, where you had an exposed position, I'm not selling the goods for $78,000. I'm selling the goods for $100,000, and I've got this hedge, a financial instrument that's got to be marked to market. The gains and losses go to the income statement. Even though in substance it's exactly the same thing happened. I'll show you something else that could happen too in a few minutes. And the next thing I do is wrap it up. And here's where you're going to see the big difference again that hedge accounting allows you to do. Look at my sales. I'm going to debit investment in foreign currency, that's that's euro currency for $75,000 because that's what I'm getting. Wait, I'm getting 78,000. No, I got 100,000 euro that's worth $75,000, right? Because that's the exchange rate. So that's 75,000. I debit my firm commitment for $3,000. This is very important. And I book a sale of $78,000 because what happened in substance? I sold the goods for $78,000 US. This is different from what I did with an exposed position. With an exposed position, I was only allowed to record $75,000 in sales. And the change in the currency was booked as the value of the hedge changed. So as that foreign currency payable to broker decreased, I got to record $3,000 in gains. But because the fair value hedge fuses the two transactions together, I now have a single sale of $78,000, and the gain didn't happen. The investment in foreign currency is $75,000, that's the amount of euros again, and now the firm commitment is wiped off my books. Last thing to do to wrap up, debit cost of goods sold, $50,000, credit inventory for $50,000. By the way, I always see this as something that students don't remember because it's covered in a lot of detail in intermediate accounting, and it's covered very quickly in financial accounting. So let's just go over this one more time too. I like to do these reviews because sometimes students just don't remember stuff. If you sell something in perpetual inventory, you're going to debit accounts receivable or cash credit sales, and then you got to take the inventory off your books and convert it to cost of goods sold. So you're going to credit inventory and debit cost of goods sold for the cost of the goods. Last thing, again, I like this transaction. This is like, to me, this is a really cool journal entry, right? So what I do is I give up my investment in foreign currency, that's 100,000 euros, and I debit the foreign currency payable to broker, that's the debt that I owe to the broker. I debit 78,000 cash because that's how much the broker has to give me, and I credit dollars receivable from broker for 78,000. My balance sheet is completely clean, and I've got here a $1,000 gain from when I marked to market on March 1st and a $1,000 loss. They're going to offset each other on the income statement, and that's it. Isn't that cool? Is it starting to make sense? Yeah, Rashil.
The whole firm commitment business is just
The what?
the firm commitment, like when you debit it, is asset or liability? That's the only part that I don't.
Firm commitment is a really weird account. So firm commitment, I think what they're doing is they kind of like stole another accounting concept. You have what's called a take or pay contract. Do you know what a take or pay contract is? A take or pay contract is, you may read about this all the time, is if you agree to buy something or sell something at a certain price. And let's say you agree to buy something at a certain price. You're going to pay $100,000. And companies do this because they want to make sure they can buy something that they need at the right price at the right time. So you have what's called a take or pay contract. And let's say you agree to pay $100,000 on a take or pay contract. And then it turns out the price of that goes down. So the accounting says that if the price of it goes down so much money that you're going to lose because you have to do this take or pay contract, you have to book a liability for that. So they kind of stole I think they kind of stole the accounting for that in creating this firm commitment here. It's not quite the same thing because this firm commitment can flip back and forth and become a liability or an asset. And that's what's one of the things that's so weird about it. If you have gains like they had here, then this is going to be a liability. If they had losses, it could go in the other direction and be an asset, believe it or not. I think the textbook example, it flips in both directions. I might be mistaken in case 3. But it's a really good question. I have a lot of trouble with that because that's where the whole, like, all of this makes sense, and that's the one piece of it that's kind of just, I don't know, it seems a little bit like nonsense. But if you see, it all cleans out in the end, so it must be right. You should never say anything like that at all. Yeah, it all balanced down to 0 in the end, so I must be doing something right. But this could flip over. Firm commitment for this scenario could flip over and become an asset. And there are other ways that this could be done. You could construct fair value hedges, let's say with interest rate swaps too. You could have a debt that's the value of the debt is variable, and you would create a firm commitment. I think they use a slightly different term for it for an interest rate swap that would offset that. So again, you're not going to disrupt your balance sheet because otherwise what would happen is if you have certain debt that has a fixed rate, then the value of that debt is going to fluctuate with interest rates, and it could drive your balance sheet wild and your income statement wild every time you market to market, and therefore you would construct this to even things out. Yeah.
So if they had a loss, you would book a loss and then you would book a gain with the firm commitment?
Yeah. You credit the gain and debit firm commitment as an asset. And how do you justify that the firm commitment is an asset? I don't know. That's for smarter people than me. But that's what the FASB allows you to do. Because what they're really concerned about, think about what they're really trying to do. What they're saying is that this is all one story. I'm selling goods for $78,000. And there's various different moving parts going in different directions, literally opposite directions in order to make it work. So I think I could come up with a more substantive explanation for you, but I'm only teaching this for the first time this way. Now, by the way, again, I want to be honest with you. I don't like to say, I want to be honest with you. This is because I use this transaction here to sell equipment to a customer in Europe. I don't know how many companies are really going to care about the liability value of the foreign currency payable to broker, or how much it's really going to influence the income statement. It's hard for me. I was thinking about this. It's hard for me to construct a real scenario where a company would book this as a fair value hedge, in all honesty. To me, this doesn't quite make sense as a fair value hedge. Maybe it does, maybe it doesn't. But I set it up this way because I want you to see the difference between all the different instruments. So again, I told you 5% of this is like sort of iffy, and that's the piece of this that's iffy. And I just want to be honest with you about this, that I'm not so sure this would be a great fair value hedge or not. I'm just not so sure about it. To me, it doesn't quite click. Now, this could go in the other direction, by the way. Here, this is a contract to sell. I could have a contract to buy, and you would just flip everything around. You could also, again, have all sorts of other, anything else that's hedgeable, you could have a fair value hedge made out of it. Okay, you ready for more? cash flow hedge. Now, believe it or not, normally when I was telling somebody today, I think I was telling Erin and Long, that it's case C where I usually fall apart in this chapter. I like get up to case C. I'm like, I must have something better to do right now. Like my brain just goes there like, okay, brain full, that's it. I'm not gonna get through case C today. Well, I think how they constructed case C is very confusing. And so what I did was I took the same problem again, but I reconstructed this now as a cash flow hedge. Now let me explain why it's a cash flow hedge and not a fair value hedge. And it's a very subtle difference here. But this will help you to understand the difference between a cash flow hedge and a fair value hedge. In the fair value hedge, I was worried about the value of the liability fluctuating, and I was worried about the mark-to-market adjustments hitting my income statement. In this case, I'm worried about the cash flow. I'm worried that I'm not going to get $78,000 from when I sell the goods. Specifically, I'm supposed to get 100,000 euros, and I don't know what 100,000 euros is going to be worth on March 1st, 2018. It could be worth more, it could be worth less. I just don't know. But I want to know. I want to know how much money I'm going to get, and I don't want to worry about it. So this is a cash flow argument. It's not a balance sheet and income argument. It's a cash flow argument. And it's distinct. Now, again, I'm streamlining like 100 pages out of FARS. I'm literally streamlining it. There's a lot more detail to this, and there's a lot more detail to determining. In fact, it's not even in FARS, really. But there's a lot more detail to determining that a hedge is ineffective. And you have to show it's effective, because what happens if it's not effective? It's an exposed position and everything falls apart. So what you would do is you would establish that the reason why I'm doing this is because I want to receive a fixed amount of money in US dollars when I sell the goods. I don't want 100,000 euros that's worth God knows what. So therefore, I establish this as a cash flow hedge. I do all the documentation, and there's certain testing you have to do also to establish that this is a cash flow, an effective cash flow hedge. I start off the same way. All the numbers are the same, so I'm not going to go through them again. You see the subtle difference? Let's just walk through the subtle differences between the motivation for the three transactions. The first one is I just don't care. I'm going to sell the goods for 100,000 euro, and I'm going to buy this security, and it should work. The second one, the fair value hedge, says I'm worried about the book value of my liability going up and down and causing all kinds of gains and losses that are going to hit my income statement. The cash flow argument is I'm worried about how much money I'm going to receive when I sell the goods. Now, the question is going to come up, are there transactions really that could be either one? And the answer is, this confused me for years, the answer is yes. There are transactions which, depending on how you document them and test them, could be a cash flow hedge or a fair value hedge. It'll be rare that a transaction could be one or the other, but it could happen. And that's exactly kind of what I'm showing you with this example. Now watch how we do it differently, because it's different. This is interesting. So first thing I do, dollars receivable from broker, $78,000. Credit foreign currency payable to broker. Look at this. I put this in the first row again because now you could figure out that I copied and pasted a lot of stuff. December 31st, but we're accountants, right? That's what we do. So December 31st, I mark to market. I'm going to debit foreign currency payable to broker to mark down that foreign currency payable to broker by $2,000 down to $76,000. And you can see that over here in this column. But instead of booking it to a gain on the income statement and offsetting it with the firm commitment, instead of going straight to the income statement with the exposed position, I'm going to stick it in OCI. It's just going to go to OCI, and we'll just leave it there for now. So now, and you remember what OCI is. OCI is a place where you put things when they're not quite where they're eventually going to go. Think of it as a shoebox. You got a shoebox, I got a shoebox. I drive my wife crazy. I love shoeboxes. I don't know why. I have like shoeboxes from every pair of shoes I ever bought. I have closets full of shoeboxes. My wife wants to, but they're very useful shoeboxes because you could put things there and you could store them and then come back and get them later. And this is a shoebox. So I put $2,000 credit into the shoebox called other comprehensive income because I'm going to deal with it later. Then, and now it's been marked to market on December 31st. On March 1st, the value of the foreign currency payable broker goes down another $1,000 to $75,000. Where am I going to stick it? Other comprehensive income again. So now I've got a $3,000 credit sitting in the shoebox. And I've got $1 receivable from broker for $78,000, dollars payable for $75,000. This is really easy to clean up, but I want you to notice what's going on again. In substance, because this is a cash flow hedge, what's happening in substance is I'm selling the goods for $78,000. The cash flow hedge, like the fair value hedge, it's an effective hedge. It's been properly documented and tested. It's one transaction. I sold goods for $78,000, and therefore I can credit sales for $78,000. Out comes the $3,000 from the shoebox, debit investment in foreign currency, that's the euros, for $75,000. So I have 100,000 euros, that's worth $75,000 on this date. I debit cost of goods sold for $50,000, credit inventory for $50,000, and last but not least, I wrap up the whole thing. I'm really excited. I can't believe I got through this mess. I debit cash for $78,000 because I got my money back from the broker. Credit dollars receivable for broker. And remember again, this was what we wanted. We wanted $78,000 and we didn't want to have to worry about how much money we got. I credit investment in foreign currency because that's on my books over there. I debit foreign currency payable to broker because I got to get that off my books also. I paid it off. And therefore, everything is off my balance sheet. The OCI, the accumulated OCI is completely gone. And I booked $78,000 in cash, in sales. So again, the exposed position is two transactions. That's why it's called exposed. You have the sale of goods for 100,000 euros, and then you have this investment in a financial instrument, in a derivative. The difference between the fair value method, the fair value hedge, and the cash flow hedge is very significant because the fair value hedge, again, my motivation was what? My motivation was to focus on the value of the liability, or it could have been an asset too. We just don't want these things flying all over and changing in value by a lot of money. We don't want to record gains and losses on our income statement when they fluctuate. We want everything to be really solid. Therefore, we enter into a fair value hedge, and everything is solidified. It's like one transaction. Now, the cash flow hedge is we use OCI instead of the offsetting gains and losses. Now, the question could come up. This is really interesting. Is what happens if, and you'll laugh at me what happens if you document your hedge and you say, I got a cash flow hedge, and you test it. There's certain testing you have to do to establish that it's an effective hedge. And on January 2nd, you test your hedge, and you discover that it's not an effective hedge. It's a very interesting question.
Goes to the P&L.
Everything goes right to the P&L immediately. You lose. The whole thing falls apart. Or, get this. This happened to Dell Computer, I remember, when these rules first came out. It's like 20 years ago already. But this was the coolest thing, right? And I think it happened to Apple once, too. The auditor determined that they didn't properly document the hedges. So, retroactively, everything that they had booked as an effective hedge completely fell apart and got converted over to be exposed positions. And all the gains and losses they put into OCI had to come out. and go right to the income statement. It blew Dell out of the water. They lost hundreds of millions of dollars. And then investors wanted to know, well, why did you have all of these foreign currency derivatives? What were you speculating in foreign currency derivatives like this? And it was a mystery why they didn't document it properly. I believe it happened to Dell. It also happened to Apple. And it was at least in the 9 figures. Both of the losses were in the 9 figures, what they were trying to do. Yeah.
So you would just take the balance of the OCI and put it on the income statement if, as a loss, if it was a loss.
Yeah, it would have to go immediately to the income statement. Now, on the other hand, what would happen if you determine on one date, you know what? They're canceling the order. You also have a loss because you don't have the offsetting pieces of the hedge anymore. It falls apart. Another thing that could happen, now let's just think about case C for a second, because case C in the book is pretty cool. Case C is where they have a cash flow hedge of a fair value hedge. And this is the one that blows everybody off, and they're like, I can't read this anymore, my brain is full. So basically what the cash flow hedge says, this one here was for a sale of goods, right? But let's say it's for, I want to enter into a fair value hedge on March 1st, 2018. And I want to buy a bond, which I'm going to have a fair value hedge against. That's a good example. So you can enter into the cash flow hedge to have the right amount of money to buy the bond. A year from now, that will be a fair value hedge. And this is the cool part. You can take the OCI that happens in the cash flow hedge and then put it into the fair value hedge. And then it comes out of the fair value hedge as it would with income. Now, there's a lot of other details to this. Again, I'm going through it really fast and streamlined. I promised Damien that I would be done in an hour, and it's like exactly an hour now. So this is how it is. You got the handout there, and you can study it. If you have questions, please email me, or you can ask me after class, and I'm going to have Damien present his half of this now and go into this really cool case with functional exchange rates.
Can I ask you
Yeah, yeah.
Or do you want to do it after?
Yeah, go ahead and ask me. If I can answer it right now, I will.
Well, I'm looking at the final entries where the bottom 2 entries where the first year's the transaction for the sale of equipment and the transaction to settle with the broker.
Yeah.
Between cash flow and fair value. The only difference I'm seeing is the fair value, the second debit entry is going to firm commitment versus the cash flow, it's OCI.
Right.
And that, if your investment in foreign currency, the 75,000, that's effectively the cash you got from the vendor. You still got 75 in both cases.
Yeah, what happened in substance in all 3 cases, and this is why this was a cool example, and I wanted to explain it this way, all 3 cases are the same. What happened between this company, its customer, and the counterparty to the derivative are all identical in all 3 cases. But the outcome on the income statement and balance sheet are actually different.
Yeah, I understand that, but if your objective in the cash flow hedge was to receive a fixed amount from the vendor, right?
Yeah.
I don't see where you accomplished that.
Oh, but go further down. I got 78,000 US dollars. I only got 100,000 US euros, right? As of March 1st, 2018, that's only worth 75,000. But when I cash in my hedge,
Right.
I get 78,000 cash US dollars.
Right, in fair value case, but that's the same, that's identical to what happened with the cash flow and the cash flow hedge.
Exactly. It is identical. But the purpose of each transaction was different. That's the only difference between these. The purpose here was to make sure you get $78,000. The purpose here was to avoid having big swings in my liabilities and income statement. So the purpose of each one, what you're thinking behind the hedge, the reason why you're entering into the hedge are for different reasons.
Okay.
And that's why the accounting is different. So can you say to your accountants, this is what I'm thinking, this is why I'm doing this, and therefore you should account for it this way? Yeah. It's really weird. But that's why the FASB is so strict about the documentation. Oh, you want to do this on your computer, Damien?
Yeah.
I said I can't record it if you do it on your computer.
Can you give to my